On today's podcast, we're doing a replay of a recent office hours where I answered a few people's questions. We do this every first Saturday of the month. Sign up for our clubs, thewealthelevator.com/club. Sign up for there and you guys will get to the links or just shoot our team an email and they can get you set up. And then the last announcement here, if you guys like these, check out our more in-depth coaching calls where we can go in-depth with a person for a full hour. But it's been a while since we've had a new batch of people roll in. So I'll make a call out there. If you guys want to do a free coaching call for an hour, we can change your name. We can make you anonymous. Reach out to the team, send us an email, and we'll probably ask you guys to maybe spend a little time, 10 minutes, make a little personal financial sheet, just so that we're a little bit more prepared when we do hit record. But great opportunity for you guys to get information and we can dive into your situation while also putting it on display for everybody else. What I've realized is all these situations are the same thing over and over again. So again, reach out to the team if you guys are interested in that and enjoy the podcast.
Oh, welcome everybody to Office Hours. We are getting into the summertime here. Any questions, type it into the Q&A. Those of you guys who jump on live are always get priority here. First question that kind of came up might have came from my email out to everybody this past week. There's a lot of operators and syndicators out there trying to save their old deals. And it may sound very valiant, but in reality, some of those deals bought in 2021 are just bought at the peak, right? 20 to 30% higher than it is today. It's going to take maybe 4, 5, 6 years for the market to get back up to that same point. So if you were to put money into those projects, you could do the math, 20% divided by 5 or 6, that's a few percent points every single year. That's just not a good investment. Ultimately, sometimes in these investments, it's just what you bought it for, no difference than what you buy a stock for. That's a way to think about it. Maybe if you would have asked everybody 3 to 6 months ago, everybody would have said that interest rates are coming down and 10-year treasury coming down, and then the cap rates will follow. Because what we saw happen when prices come down 20 to 30% off the peaks, what's indicative of that is the cap rates jump up. So when we enter deals, we try to be conservative, and this is in the syndication e-course for all you guys to access. I think it's in the maybe section 4. There's this thing called the reversion or exit cap rate, and you compare it to what is the prevailing cap rate today. Not in particular of the property, but what are similar assets in that submarket selling for today, the prevailing cap rate. So let's just say Phoenix Class A might have been trading at 3.5% in 2020 to 2022. Now that has jumped up 1.5%, maybe 2%. So maybe it might be trading in the high 6s now, for example. It sounds like small numbers, but it's a huge difference because what does that matter? The value of properties is from this formula where you take the net operating income divided by whatever the prevailing cap rate for that asset in that submarket. So if you can see the denominator getting bigger, the value of the property is drastically coming down. And that's what had happened, right? Like places like Phoenix, you had the cap rate jump up 2 whole percent points. Going back to kind of what is normal conservative underwriting, usually 0.5% is considered pretty industry standard of you're being pretty damn conservative there. What we saw is something 3x that, maybe 3.5x that. So what I tell investors is you try to be conservative. In this case, maybe you build a 10-foot sandbag wall to protect against the hurricane or the flood. But what you saw over this last bigger correction than 2008 in reality was a 30, 35-foot wave that crested that 10-foot sandbag wall. And some people might say, why don't you build a bigger wall? I mean, you just don't do that, right? You're in these investments to make money. And if you just keep piling more principal or capital in here, then your return on investment goes way, way down. So it's no different than buying a little rental property and holding thousands of dollars of extra down payment, doing nothing. But you obviously want to be somewhat conservative. So when you look at deals, you want to look for that particular buffer to account for most corrections. But Obviously, what we saw this last correction was something much, much bigger than that. Interest rates wise, what everybody expects to see is a gradual decrease in these cap rates as the buyers come back into the market. And sure, the prices have come back a lot lower at this point, 20, 30% lower than a few years ago. But where the loan packages are, because sure, you need to buy the property at cheap, which I would say now is probably a really good time. But the loan packages, you're not able to get you're getting higher interest rates, and also the loan to values are going to be a lot lower than what you could get. So maybe a few years ago, you could get maybe 75, 80% leverage. Today, it's probably 10, 20% less than that today.
So it used to be probably about a couple of years ago, we could get 70% loan to value on acquisitions. And that has gone down to about 55%, maybe even lower, which means like I have to bring like half of the money to the table for a down payment, which means if I would have previously bought an asset where $10 million for the capital raise, that would have been the equity. Now, today, even with the price being a little bit lower, I still have to bring more money in. So probably be like $13, $14 million capital raise. And at that point, if you could imagine, we're still trying to make the same amount of returns. And at that point, there's more investors involved, almost 30% more investors. So you could imagine how projected returns would go down. There's just more people to share the returns with because you have more equity, more bigger of a capital raise.
If you're buying a $20 million asset, you've got to bring maybe several $1 million extra to the table, which obviously kills the return on investment economics there. And thus, no deal, no bueno. If the reward's not there, then you just don't do the deal, which is why after 2022, there was a while there where we didn't really look at anything, just didn't even make sense. Recently, we've done some deals, some small deals. It was assumable debt at 3.8%. Now, those are anomalies. It just very rarely happens. But I think what you're starting to see out there is everybody thought that the interest rates were going to come down and then the cap rates would follow. But you had this wonky thing happen where the 10-year treasury actually went the opposite way, which you're probably like, what the heck is going on here? Obviously, the whole tariffs thing is creating a lot of instability. I'll get into that next in my next topic. But from there, you start to see, wow, it's going to be higher for longer. And boy, was it higher for longer, right? Even up to this point, everybody had this slogan saying, survive to 2025. 2025 is here. We're well into it. It's almost the summertime. And at this point, a lot of those people who are trying to hold on for dear life, they're going to have to hold on for longer, and they probably won't make it. And even if they do make it, I guess to my very first point here, it's just not worth it because you're going to have to wait for 5, 6 years for you to get out of the asset. But the return metrics on that is going to be just horrible. You probably would have been better off in new deals today that are fresh with mainly new reset bases of today than to stick it out in the old ones. But every deal is different, right? Every deal has different loan terms on it. A lot of this goes well beyond how the asset is operating at this point with a huge correction of 20 to 30% in some areas. So yeah, a lot of people are stacking in debt in the deal. In some cases, it makes sense. Again, if it's a deal with a very high basis, then it just doesn't make sense. You as the investor need to look at the deal and assess how much is the asset worth today. Most times an operator will call and say, we don't know. That's the truth, right? Nobody really knows what the asset is worth until you go to market. And then you get around the bidders and you actually go through the buyer's due diligence processes. They start to find issues wrong and maybe they get some concessions here or there. But you could probably get, if you're talking like a $20, $30 million property, you could probably get a good broker price opinion from the broker, plus or minus $1 million, just to get you in the range. What you should know for sure is what is the senior debt. So these are two very important numbers. If the current value of the property is near or under the senior debt, then red flags should go off for sure. Because a lot of these guys are putting the debt right on top of the senior debt in between the common equity. So the common equity is the portion that's pushed out of the capital stack if there's not enough to pay back investors. Said in a different way, say the assets were to be foresold. The senior debt is paid off first, and then any member loans or debt, preferred equity, then the common equity. So that's why it's important in these cases, these dire situations, that you want to be positioned higher in the capital stack. This is confusing, but you know what? I think tough times have created these situations where everybody's had to be educated on these types of, this is where you learn these types of things. If you're entering in the market after 2023, 2024, technically it's a moot point. I think you're buying properties at the reset basis. And it's, again, a lot of the things that I'm going into, these advanced technicalities are more dealing with older deals with the crappy bases of several years ago. I guess maybe an example here, say a property was worth $100 million in 2021 and with a $75 million loan. And very realistically, the property could just be worth 70 million a year later when everything came crashing. And I want to say 2023, late 2023 was when the prices really reflected downwards. And it was hard to tell at the time. Now, a year plus later, a lot of these evaluations are more established at this point. So again, $100 million property, now worth 70, your senior debt's at 75. As you can tell in that situation, even the senior debt is not going to be made whole. And certainly there's going to be nothing for passive investors at that point. But the key thing here is if you're looking to put more money into those deals, you got to be careful where that goes. And this is a mistake that a lot of people make out here, right? Myself included. I put my own personal money and lost it in this. That's how I learned. It's definitely a very emotional kind of experience. But again, I think when things are back up on the upslope, which I think maybe we're at the bottom now, these are some of the lessons that are missed. So maybe somebody will listen to this recording in 5-6 years when normally market cycles last 6 to 10 years. And these are the things that you need to pull in the back of your head and remember, because they are actually more applicable at that point because you're at the top of that market cycle. Essentially, nobody needs to dust off their resume writing skills. I guess if you're AI nowadays, but nobody needs to dust off these skills when it's a very open job market for employees. But when things are tight, like today, that's when you need to dust out some of these skills. And that's what I'm saying. Maybe learn this now. It probably isn't applicable if you're looking at 2024, 2025 vintage deals and beyond, because the bases have been reset downward. Lucky guys. But this is something that I would say maybe you pull out of the hat. And I think ITR Economics is predicting a huge correction in the early 2030s. It's a big thing. Says a lot of these global debt issues are just swept into the next presidency and next decade. So I guess like the lessons learned here, if you're a new investor with a good reset basis, then you don't have to really worry about this stuff. Revisit this in 5 to 6 years, perhaps. But if you're an older investor, unfortunately investing in the worst time in the last 40, 50 plus years, or maybe, I mean, it was worse than 2008. Before you dump more money, you try and save a sinking ship. You ask, what is the property worth today? And what is the loan balance? And is that property worth less or close to the loan balance? Stay away. Even if the property is operating at 105%, which is not possible, obviously. Some of these funds out there are offering like 12 to 15% returns, which sound great given that risk factor. And that's a problem. You don't know where they're putting your money, especially if it's a fund, right? That's just how blind pool funds work. In my opinion, based on the risk, you probably should be getting something more like 15, 16% plus. Or some of you guys have a more of an aggressive attitude, especially after the bases have been reset. And none of this is investment advice, right? Like it depends on how you want to play this in your own personal portfolio. Some people look at this and say, the bases have been reset. My downside is somewhat hedged here because like how much lower can it go? We're already starting to see assets come up in value. This is just one data point here. But we had an asset earlier in 2024 was at one time valued at 22, 23 million. And then late 2024, we had an appraisal at 27 million, I think. And I like to say, yeah, we did a lot of hard work at the asset. We did a lot of cool things, but in reality, we didn't really do too much. we're just holding down the fort. So a lot of that was just kind of market appreciation. That's just one data point. So if you're looking this from a optimistic standpoint, which take the old Warren Buffett quote, when there's fear in the streets, that's when you get after it. You could read that as now being that time. After all the assets are devalued by quite a bit, now's the time to get involved. If you're thinking that way, then it's like, why would you want to go into anything at preferred equity or debt return at 12 to 14%? Go after the common equity, especially on new deals where the bases have been reset. This is where in the market cycle where you get the huge outside returns. If you're looking academically at it back in, nobody knew this at the time, but in 2008, there was the big great recession and decrease in pretty much all asset classes. But around 2010 was when you really hit that upslope. That was where, when I was first getting involved in this world, right, I got that little bounce off the bottom. I wouldn't call it, some people are like, it could be like a dead cat bounce. I've never really seen, if you go look at real estate or these types of asset classes, I guess it could happen, but look at the fundamentals, right? Like people need a place to live. There's a lot of new supply coming online in the next 6 to 18 months. All that new inventory is hitting the market now, but new builds drastically went down after 2023 to 2024. Nobody built anything right now, but you know and forecast that around 2026, 27, all that new supply is going to drop off a cliff. Of course, that's all speculation, right? I'm always trying to point both sides of the bulls and the bears argument here. And a question for, I know a lot of people invest in like Dallas. So like cap rates, where cap rates are today, Class A in Dallas, again, similar to Phoenix, maybe traded in, I think it traded a little bit higher than Phoenix, just as a market in general, maybe by a quarter of a point higher. So I'm going to guess and say in the peak of the market in 2022, it traded at 3.5. This is why we underwrite the deals separately, right? We always try and get the underwriting. And this is something where an investor could just take the pitch deck, throw it into ChatGPT and ask, what is the prevailing cap rate? You could ask ChatGPT, can you find me the reversion cap rate? And say ChatGPT says, yeah, I found it. The operator assumed that they exit at a 4.25, which is higher than what the prevailing cap rate for that asset, as we mentioned earlier, 3.5%. So that'd be an increase of 75 basis points, going from 3.5 to 4.25. So obviously that's pretty good, right? I think that's a fair conservative amount. But today, with this huge monumental shift, the Class A might be trading for 5.5, 6.5 range, which means that the market needs to get better by a full 1 to 2% points just to get back to where you originally thought the deal could exit at. And that could take 5 to 10 years, like I said. So I know some people, they show me some old deals that they're in, and I'm like, yeah, we pull it up and we throw those pitch decks in ChatGPT. And unfortunately, maybe a certain deal, not going to say where, but certain deal was underwrote to exit at a 4.75. And I know those markets are now damn near 6 at this point. And for that to come down 1.25%, that's going to take freaking forever, even if it does in the next 5 to 10 years. Yeah, at the end of the day, it's what you bought the property for. Unfortunately, that is timing. It really is timing, which is why I take the approach personally. I'm not giving anybody advice here, but personally, I learned that I luckily was diversified over 4 to 7 years. So it's not like everything was just blown out of the water. And that was where, through this last correction, I was reminded, oh, that's why one should do that. It's not fun to go through these corrections, but I think there's always lessons learned. Or you just take the approach of, I'll never do this again. I'll just go back to the stock market. But we all know what's going to happen if you did that. So that's my little talk on that. Let me go over this question. This one's very timely. Right? With all this tariff stuff going on, how does that really impact the real estate, renovating properties, construction, etc.? So first thing I'll say is it doesn't impact it too much, and I'll drill into the specifics here. But I will just say, thank goodness that it's not for once, because the last several years with interest rates were the main thing. interest rates skyrocketed, and boy, does it freaking impact real estate and the banking sector. It really, is tumultuous for those two sectors. If you look at ITR economics, it breaks down all the industries like banking, new housing construction, real estate, and then all these other industries, which I would say predominantly makes up the most of the industry economy in America. When the interest rates went high, it just plummeted real estate and banking sector. And now they have it predicting that we're on the upswing here. With tariffs, it really impacts everything. I can't imagine for e-commerce operators, that just screws you, right? Or anybody who produces things with raw materials from overseas. How the heck do you price that in? Your competitor, what are they going to do? Because at the end of the day, your role as a distributor or manufacturer taking in his raw materials is to source the best pricing. But there's so much instability. And now where do I get that raw material from? Where do I get that wood or plastics or what I used to get? And I can't just switch right away and my reserves are getting lower. Do I temporarily not price in these increases to buffer my customers so they don't go start shopping around and I lose my B2B client forever? These are the thoughts that are happening to business owners for the tariffs. And I'm sure they don't sleep at night. There's other things that keep me up for sure, but that's not one of them. Specifically looking at real estate projects, how tariffs do impact things. First thing, the prices of materials and just general inflation. So I think we'll all agree that standardly accepted that tariffs are inflationary. What you're going to have start to happen and prices will start to go up. And then these ding dongs who aren't even impacted by tariffs start to raise prices because it's just a good excuse. It's not right, but it is what happens. We haven't really seen too much of it in the data yet, but I think that's because everybody's just working through the raw material stores at this point. But there's going to become a point in time, if this continues and this is not resolved out, that you're going to start to see the prices start to go up. So it's pro-inflationary. Now, obviously, that makes if you look at the P&Ls for properties, you've got your taxes, insurance. Those are the things that drastically increased over the last several years. We had a property where it went from $150,000 at purchase to $450,000 today, just a few years. Of course, we improved the value of the property, but that's just a stark reality of where things are at, which is taxes. And I'm sure everybody out there is understanding what's going on with insurance because now it's finally hitting the residential sector. As much as we sold some properties in 2020 that we had in Mississippi where the insurance tripled. Most people have the understanding that a lot of that is inflation based. I've talked to some insurance professionals, and I think that they're just using that as a little bit of an excuse, especially Florida. This is why Florida's insurance is so expensive. Florida has a lot of litigation issues. The thing that makes it so damn expensive is for some strange reason, when a hurricane comes through, they have to fight. The insurance carrier and all these industries have to fight, and it creates a lot of legal costs. And that's what really inflates the cost for the insurance carriers at the end of the day. So it's not just inflation, but it doesn't matter. Who cares, right? Like the insurance skyrockets too. I would say that those are at this point, it's already gone up so much. I'm sure it's going to go up again. But I think at this point, maybe we've hit some stabilization. We're starting to see some insurance. We just negotiated a rate down by 17% on one of the assets for the insurance. And we always appeal the taxes and get a little relief there. But I would say take those two out of the P&L statement and you look at all like the salaries have gone up. That's inflationary. And then your raw materials. But now you have to look at each deal, right? If it's a development deal, your raw material costs are going to be a huge part of the cost. But if you're more in a value add play or just we've got like a deal that comes to mind where we're not really doing too much to the property, we're just flipping it essentially. The cost of materials, if not purchased already, is pretty minimal. So I was thinking about an extreme example in my head. So in one of our past developments in 2020, we went through Lumbergeddon, if you recall. Maybe you forgot, but lumber's 4x the prices. It was ridiculous. The joke was if you want to take your spouse to a fancy restaurant, take them to Home Depot and have a candlelight dinner there because the thing was like super expensive. And at the time we had a choice where we're like, we're midway through the project and we were like, I think we should just buy the lumber at the pricing the elevated pricing it is now, because it's probably going to go up even more. But anyway, prices like 4x in that project, you're talking like huge cost increase there. Now, granted, lumber and all these other inflation impacted materials is maybe half of the cost. And if it goes up, maybe you could subject that. I think at the end of the day, obviously a lot of line items of materials and different inflation rates of that it went up. But I think at the end of the day, maybe it costs like 30% more to complete the project. So we got over that hump. But that then, the Lumbergeddon of post-COVID was way more of a increase than what we're seeing now with a little tariff action inflating some of these raw materials today. So again, we actually went through those experiences ourselves, teach us these types of things. That's why I'm not too concerned with it, because we've seen way worse in the past. But if you try to quantify that dollar amount that a project like that has, is a lot more impactful than some inflation of 5%, 10%. Of course, if you stack this year by year, if you stack 10% on 10%, 10%, then you're talking much more than 30, 35%. We're not there yet, right? This has only gone on for maybe a quarter at the most here. Something to watch, but I would assume if it keeps going on, if you're going into a new development deal, they should underwrite these types of appropriate cost increases. But as far as a multifamily value add, your exposure to these things is much, much less than development deal. And again, that's why I use a development deal as an example, is you can see how impactful inflation is, but how it's dwarfed by Lumbergeddon of several years ago. Bringing this back to, I would say, yeah, it's impactful, but inflation is, if you're a real estate investor or a commodity investor, inflation is your friend, folks. Inflation is, unfortunately, the way I see it, is a tax on the poor, or people who don't have money invested in assets that go up with the pace of inflation or beat it. So that's why you invest in assets. And if you pick real estate, I think real estate's a great diversified pool of investments or commodities. If you buy a stick of lumber today and inflation goes up, it's no different than gold, right? Or what the usage for gold, but it's diversified in a way. So you get the lumber, you get the concrete, all these other raw materials in there. You may not realize it when you invest in these types of assets, but essentially is, right? The theory here, and this is, again, just theory, that if it costs you a little bit more to build the same house, that house is going to be worth a little bit more plus a multiplier there too, right? Again, this is just theory. You may or may not agree with me, but can you find anything else that is able to also weather the storms? So think about it, like if you were to have a flood through your town, what are the things that are going to stay stuck on the bottom and get flooded, like your car, for example? Whereas I think like your real estate would be like a boat in a way. And as the flood comes in, the flood would just carry the boat. In a way, real estate and other assets, the commodities such as real estate go up in value in an inflationary time. So I think that's that's a plus there, right? Where what I mentioned earlier was more of a mild negative. So my gut tells me that, sure, at the end of the day, if you want to argue me and say, yeah, it's a negative, an overall negative, I would say probably it's a slight negative. That said, if inflation comes back like a mother, like how we saw it in 2020, 2021, the prices of these assets were just skyrocketing at that time. And you want to be in a boat, or you want to have money in commodities such as real estate to get positive exposure to that. So I'm not afraid of inflation, to me. If you're on a fixed budget, you're a retiree or somebody who's just completely in cash, you're going to get killed in inflationary times, which is probably what's predicted in the future. It's the age-old thing of you got your money making 1% in the bank, but you're losing 5% to inflation or hidden inflation statistics. A great website for that is Shadow Statistics to see what the true impact of inflation is. But if you're not in a deal that's a development where you have huge impacts to what your materials cost, I still think that you're going to recoup it on the back end when that asset inflates in value along with all the other inflationary types of products out there too. You asked me, this is just my take on the whole situation. Everybody talks about Trump, right? And because they like to talk about one individual person. But I think they need to create some kind of pain in the economy. For some reason, everybody, they associate the stock market with the economy, which is not. The economy to me is what is industrial production, that type of stuff. The perception is reality, as they say. The general public looks at the stock market as what the economy is. So they need to hurt the perception, which is the stock market, with these types of mini poison pill so they can have the Fed lower the interest rates, maybe temporarily. So maybe there's a good buying moment or refinance moment for those you guys in deals coming up. But I think this coincides with a bigger picture that the US debt is getting a lot huger. It'd be nice for them to refinance all their massive debt with a little bit of a temporary decrease in the interest rates. It doesn't solve the problem, but it just kicks the can down the road again. So I think this is where they try and influence the Fed, Jerome Powell, to lower the interest rates in the temporary portion. We all know interest rates aren't going to be coming down anytime soon, which is why we've looked to expand deal flow into buying businesses. So we know we have a lot of investors out there that own businesses, maybe know other people who are retiring. Please reach out to us on the deal flow front. A lot of this is grassroots deal hunting in a way. Maybe you're somebody that we'd like to buy the business from, for example. The reason being is real estate was a great way that I built my wealth, but that was at a time where interest rates were very low. And if you look at the Chatham Financial Curve or the CME forecast, which are the two places everybody here should have bookmarked, hopefully you don't incessantly look at it every single week or month like I do. But generally speaking, the interest rates aren't going to be coming down anytime soon. So the era of free money or the Fed rate being under 3% threshold ain't coming back anytime soon. So that's why to get the ROI, to seek alpha, as they say, we've got to go to a little bit more audacious business plans, more risk, more reward, some would call it. But you no longer can buy a little single family home and rent it out. When I first started to do this back in 2009, or even as late as 2012, I was buying like a property in Birmingham for 85 grand that rented for $900 a month. In 2015 and 16, that same property was about 110 grand rented for the same dang thing. Today, that property is probably worth 140 grand and rents for 1,200, if that. So see, things have gotten worse, and that is just one data point, but indicative of kind of the point I'm trying to make here. You can't just buy real estate. You can't even do like minimal cosmetic renovations and create value overnight. You've got to take on more value add, whether it's a bigger construction project or more distressed asset, or go to a different asset class or diversify to different asset classes too. So yeah, that's my call to action. If some of you guys are business owners and you're looking to sell, we'd like to buy possibly, or if any operators looking to expand. We've done some past PE projects, but I think a lot of it needs to be predicated on, we know the people involved. I think that's what we've learned, especially through the real estate projects. Real estate operators come and go. Some even get too big and they go institutional. And then you've lost your deal flow because they stop accepting checks under $1 million, which is, by the way, some of the deals that we like to target, right? Some of these more family office targeted deals on the lower end, right? When you're talking about operators under $1 billion of deals, that's a place where I've had a lot of struggle with. It's taken a while since when I got into this world in 2016 to decipher who are the real operators out there. And yeah, now everybody has gone through a huge correction and there should be blood and lessons learned there. If not, they're lying. We've always been transparent with that, that we've struggled ourselves tremendously. And this is also why if investors need to understand, that's why you diversify your portfolio out. And also now reminded that even the stock stuff through its own market cycles too. The crypto guys, they know this well too much. Maybe a crypto cycle is usually 2 to 4 years. It seems twice or 3 times as quick as your normal stock or real estate cycle. But past lessons is no indicator of future success or protection. It's always something different. But we got time for another question. If you guys put in the Q&A, let me see. Okay. So question, what has been your experience in REIT, real estate investment platforms? I'm not going to name these so I don't get in trouble. The ones that are on the websites that are venture capital backed, that have a lot of marketing dollars, that create this portal for all these investments that are supposedly vetted by platform. But yeah, my answer to that is, look, when you're looking at these platforms, remember that they're the middleman in the mix. And these middlemen are essentially broker dealers, right? They're not the operators. And that's the whole idea is, yeah, you can invest in a REIT, but the problem with REITs is there's huge hidden fees on this stuff, and you can see it in your returns, right? That's why when you look at a syndication deals, you see what the projected returns, and all that should be net of fees and splits, right? So it's more transparent. That's why sometimes I say it doesn't matter what the fees and splits are. The operator is forecasting to get this, right? And that's where, of course, investors need to go through the syndication e-course, understand if the deal is being underwritten appropriately, right? Because sometimes, as we mentioned earlier in the call today, some operators may use a reversion or exit cap equal to the prevailing cap rate, which to me is not really conservative. So what do? You normalize it. And I've done this so many times, and it's easier if you have the model, right? But if I were to normalize it, I would increase the reversion cap rate by 0.5 percentage point. Ultimately, what that typically does is, say that deal originally underwrote at 100% return in 5 years. If you normalize the reversion cap rate to what it should be, it probably makes that 100% go down to 65%. And then you're like, well, shoot, I don't want to invest in that deal. That deal sucks, right? But the problem is, it is a bit of a cat and mouse game with operators and investors, that it's your job to figure out these things. And that's my role, is like just to educate people and general understanding on these gotchas that I think are being played out there, and at least allow you to normalize all these apples to oranges types of deals out there. And that's where people are like, well, I'm just overwhelmed. And I say, just go to the e-course, right? Just start learning. If anything, just learn the vernacular. A lot of y'all are smart people. You guys will figure it out. If not, just increase your education and understanding. After all, you're investing big dollars in this type of stuff. I think it's well worth it to put in the effort. I think there's a false sense of security in some of these platforms that put some of these deals out as broker dealers. I read some of their marketing and I'm like, that doesn't mean that you have skin in the game or you're backing the deal up as a co-sponsor or operator. You're just putting the deal out as a broker in a way. Whether the deal goes good or bad, you already made your money. And that's how these platforms make money. They just essentially get fees for putting the deal up. We've talked about this in the podcast in the past, but like that, this is where they say there's some checklist thing. To me, I look at that as AI, copy pasta, just filler stuff, filler like content to make people feel good. Because what's in due diligence, right? It could mean just walking the property and doing nothing else, doing nothing with the numbers. It could be a full due diligence. We're looking at a deal right now. I'm not going to say that we look at 1,000 deals, because that's silly. Like, that's a waste of time. Some people say that we look at 1,000 deals. Like, BS, you're not looking at 1,000 deals. If not, your processes are all wrong, right? That's just not practical.
One of our tricks that we've used in the past is we don't really underwrite 50, 100 deals. That's ridiculous, because most of them just won't pencil. Sometimes what we do is when a broker says, hey, this deal is good, guys, we'll send it right to our loan broker to underwrite it. Because if the loan broker underwrites it and they won't give us a loan on it, we're not going to even look at it in the first place. So that kind of helps us save a lot of time and energy.
The way we do it is we have ranges of certain things that we look at that are good. Then we'll take maybe 20 deals and start to actually look at it and go through it. And right now, at any one time, we're past that stage and maybe looking at 3 to 5 deals in more of a closer light. And when I mean that, take the P&Ls, take the rent rolls, putting it manually into our analyzer, and then going in and pulling the data on what the comps are, because the comps really drive, especially in value add properties, what you can do in the asset. That's really where the bumps come up. And I think that's the hardest thing for passive investors to get a handle on. You can check what the reversion cap rate is. You can see what the full-time occupancy is. Better not be anything higher than 95%, for example. And you can see what the escalators are, right? What is the assumptions for inflation and just general cost increase? But where you have to trust the operator is, do you guys think that what's the market rents for a 2-bedroom out there for an upgrades? Is it 1175 or is it 1200 a month? Right. That's, I think, where we overlay our experience on top of it. And we also have access to the data to get good on those comps. And then, but that's the extent of where we're looking at maybe 3 to 5 of these projects every month. Right now, I'll tell you, we're past the stage of that. I'll throw it to another underwriter just for another opinion, because humans are biased. I think that's one nice thing about AI. And I'm not saying that this is a good way of doing it, but for a investor that's new, throwing it into ChatGPT and just querying questions, right? Like a lot of the questions that we have in the syndication e-course, just if anything, just to learn. That's why we say, like, the best way to learn is to give us a call and maybe talk through a deal, discuss it. That way, you're probably not going to invest in that deal, but just live target practice on a live deal, I think gets discussion, and that's where you learn the best. Then going through the syndication e-course, which is more of an academic approach. It doesn't really come alive until you talk about a real deal. But that's where right now, taking you through this process, because it reminds me of the next step that we have to do, because I got a meeting next week. We do like a virtual meeting with third party. So I'm not biased, right? And then I sharp to shoot the question, right? I'm like, what about this? One thing, for example, the washer dryers is a big part of the value add. And I think half of them have already been upgraded. What's the business plan here? Because sometimes you can have the washer dryers, you have a barbell type of clientele. You have your legacy tenants who just can't afford it. You've already pushed the rents up high enough. Or you may have the entire tenant base who want washer dryers. And so therefore you can absorb that additional costs and rent increase. That's what we're digging. That's one of the things I got on my list here to sharpshoot. And you can see we're getting really nitty gritty here. At this point, the needle isn't moving too much, but we just want to get these uncertainties. There's always going to be uncertainties, but vet some of these things to just get a little bit more fine tuned on the pencil. After that, then we move forward with the deal, obviously, but that's like the levels that we go through. I think that's a little bit behind the curtain in a way on vetting the deal. Of course, you got to vet the people, right? I think a lot of it is networks and communities of other general partners that we're a part of and know within our ecosystem. But, and then also you guys, a lot of you guys, past investors, will tell us about some projects you might be involved in. No better way of learning who not to invest in by talking to somebody, which I think is why some of you guys are in certain projects. I see one guy here. We are going to start to pursue and have discussions with an operator that one of you guys mentioned here. The same operator you mentioned was another operator that another guy mentioned that I had a discussion with this week. They've actually worked with the same operator. This is cool, right? When you have this web of investors and operators, and somebody we worked with in the past, for example, was our contractor, and the contractors and property managers know who are the good operators out there. Sometimes I'll argue that the brokers, they know who people are, but they don't really know the brokers, right? They don't know what happens after somebody buys a deal. So their referrals are a little bit taken with a grain of salt. But yeah, this is, I think, unfortunately, this world that we live in, off the beaten path, alternative investments, investing directly in a deal it's a relationship game. And if you aren't able to make relationships, then just go invest in the crappy deals on some internet platform and pay their fees. And one thing I would caution is sometimes the capital stack or the deal that they're getting, that they put out, that they buy wholesale and sell retail to all their investors on their platform, is a different part of the capital stack or even different deal than what goes out to the more sophisticated family office investors or bigger investors like us. I'm not suggesting this, but I've seen it actually happen where there are certain deals that go out on those platforms that are just more of the garbage deals that maybe we've passed on in the past.
Oh, okay. This is in case, what if one of the general partners die question, right?
Oh, I don't want you to die. I just want you to not be able to work.
Yeah. Or I think what you really have to think about as an investor is, what if we lose motivation? That's truthfully the bigger concern. If we died, what will probably happen is these investments that we run, it's something that any private equity firm could run, right? Especially once you're through the acquisition phase and you got your capital set. Luckily, in these times, there is a couple of us, right? You have a pilot, and just in case one person has a heart attack, there's another co-pilot there to fly the plane. But we don't have keyman insurance. That's just not something we really thought that it was worth getting. And it's just an extra cost that would be, passed on to investors. But currently the system now is there's a couple of pilots just in case. But even if sometimes we do literally fly together, which we should stop doing. But in that case, right, we have a succession plan in terms of our lawyer would get involved and likely go through a process of interviewing a new candidate and a professional manager. And it's just like a lot of the people that we hire. We're working with one headhunter firm to get candidates, which we're interviewing. We'll go through that similar process and we'll find somebody to continue on the business plan or bring the plane back down at some point.
That does help. You're going to be doing some deals on your own. What my question is, there's nobody immediately, the wealth elevator to be called soon, that is going to be your successor necessarily, who could just take over. It would go into a lawyer situation, trying to find somebody or to either run it or sell things off. And then investors' money would be in limbo for a while until that's figured out, correct?
Not really. The plane's already in autopilot. The property managers, I think what you're looking for is who's the asset manager, right? That is our person who has the experience to manage the property manager.
Yes, correct.
Right? The property manager are the people who are boots on the ground. That won't change, right? So it's just, let's just think back at your guys' jobs. There's the technician, this person that's doing the thing. That person isn't going anywhere, right? It's the manager role. And as you guys know, sometimes people can work without managers for some time. Sometimes they're even happier when they don't have a manager. But that's the role that we're talking about, the asset manager. And in our world, there are a lot of white collar professionals in that type of field. I guess maybe similarly, like the closest thing maybe that I think might resonate is like on the construction projects. So you have the property management, and you have when we're in construction, we have the superintendent who's like the manager of all the work groups and all the crew members. That is obviously a key personnel. The question is, what happens if that person goes away? It just gets rehired out. It's just, as you could imagine, there's a dime a dozen, right? They have colleges and people go through college and they come on to pump out these really good white collar soldiers. And that's the professional we would go and get and interview. So there's plenty of these guys.
Got it.
And that's what makes it on the construction side. That was the role that I play. I was that poor sap who, if you have less than 5 years of experience, they only pay you $100,000. But if you're a journeyman who's done it for 15, 20 years, maybe you can get $200,000 or get yourself up to $250,000 a year. But boy, are you leaving a lot of money on the table unless you're on the owner side, or like how you guys are the investors. And that's just how that world works. And the little peddly construction engineer, superintendent, as you're seeing now, they're pretty replaceable. And what I would go look at, like the person that I'm talking about is like in an investment firm or private equity company, you'll typically have somebody who was like a property manager for a decade, and then that's considered more of the operations side. And they jump on the investment management side of the house, and they become more of an asset manager for a private equity firm. But that's what we are, right? We are a private equity firm, essentially. And that's the kind of person that is hired for, I think, that role that I think you're having in mind now.
Yeah, I got it. Thank you.
What's your opinion on just going for gold versus hanging out around like that base layer?
I joined the family office group, man. These are the lifelong questions that we ask. What the heck is life all about after 5 million net worth? You're eventually going to get to 8 figures really easily, probably before your 50th birthday. Let's face it. What's life all about? I don't know. I question that myself. I'm searching myself, right? But at least you'll be around other people thinking the same way. And I talk about it in the new book. If I were to propose 2 paths for you, one path would be like, all right, just cruising at 5 million, and eventually it grows to 8 figures by the time you're 50 years old, and just enjoying life. And you'll eventually maybe have kids. I don't know. I think I have young kids now. I grew up too in the meantime.
Yeah, I know you.
We have kids now too. Yeah, and just enjoying that while it's happening, as opposed to working, or keep investing. and getting yourself to that 50, $100 million level, if that's what you truly aspire to. So it could mean pulling back and just going back into traditional investments. You go back to it. And we have some people in the family office group that have gotten to this level, and they're putting their investments from alternatives back to traditional. And if people are listening now, I always have to say this: people, you guys' net worth is not 4 to 5 million. Put your earmuffs on right now. Don't listen to the thing we're saying. You need to get your net worth to 5 mil before you even start thinking about doing this. But there are some other strategies out there, like using security backline of credits, different indexes, where it's maybe not the double digit, but at a very like low effort level, you can make a pretty good return and just live off your 5 million. It's say 8%. On the other hand, the reason why some people get here is they're good investors. They have a camaraderie of other connections and they know where to go for deals. I might put you in this category, right? It's fun to you, right? So why not just keep doing the same thing and keep it rolling? But for what, right? So those are like the two ends of the spectrum. You'll fall somewhere between that.
Is that 8% after inflation?
I know that question always comes up. Don't worry about it, dude. Think about it from this perspective, right? If you have 5 million at 8%, 400 grand divided by 12, that's 33 grand a month of passive cash flow. That's above that magic $25,000 per month. So that $25,000 per month is a magic number for a couple of reasons. I don't think you can spend that much unless you're being a little bit of a tool.
Wait, I've been a tool, admit it.
Okay. Last year at our retreat in Hawaii, which you didn't come, it broke my heart.
I'm so sorry. You would be proud of me.
You're working. Okay. We lined up everybody in terms of what is everybody's monthly burn rate. And nobody, even some of the high rollers, were above 25,000 per month.
Got it. Okay.
So
I'm like 20.
Yeah. It's hard to get above 25.
Really? I haven't done it yet. So
unless you do douchey things, which I'm sure one day I'll do these douchey things, like renting the Ferrari, $100 bottles of wine, like several times a week, right? It's hard to get over that threshold.
Okay.
So it's a sticking point. A sticking point you want to blast through maybe. But $20,000, $25,000 a month, you're living an awesome life. And your net worth is not decreasing. It's actually growing because you probably have a surplus of $5,000 a month to $10,000 a month, which is a lot more than most people have. Most people in our group are saving $5,000 a month, something like that. That's after you burn 25 grand. And this is why I'm saying, don't worry about inflation or like, cool. You're good, man.
Looks like we've hit the top of the hour. Thank you all for jumping on. I know everybody's pretty busy on the weekends here. We try and do this first Saturday of the month. If you guys have any questions, submit it for next time. Thank you all for coming. We'll see you guys next time. Bye.